Asset Management, joining us on the show. Mr. Jaju, give us some sense that what this 50 basis point of rate cut announcement means for the Indian bonds, because yes, Indian bond market did turn a bit of volatile post and during the announcement as well. But what will be the larger implications?
So, there seems to be a case of upfronting of the entire possibility of the rate cuts, and therefore the stance is now changed to neutral, which means that possibility of the future rate cuts are low, and that gives the market a reference point for the terminal rate in the current cycle. So, therefore, market will now expect 5.5% to be the final rate at the end of the current interest rate cycle, and therefore market can price the 10-year yield with reference to 5.5%. So assuming a spread of about 75 basis points, the 10-year yield is now quoting at around 6.25%. To the extent that RBI's stance is, or the approach is still very accommodative, they are there to support growth and stabilize the financial markets. Once they stop cutting rates, they will move to the other parallel measures like the open market operations or injecting liquidity or conducting daily life operations. So therefore, market will continue to get support, but then the 10-year yield for now seems to be anchored at around 6.25% basis the fact that the terminal rate in the current cycle could be around 5.5%.
Mr. Jaju, this is Varun this side. I just wanted to understand the behavior of the bond yields today, because after the rate cut and CRR announcement, the bond yield went down to 6.13, but again we have seen the bond yield rising back to 6.2 and 6.22%. So what's the reason for this? How do you read that?
Yeah, so the primary driver for that is the fact that the stance is now changed to neutral. A neutral stance means that the possibility of rate cuts in quick future or immediate future is much lower. So market has a reference point. So let's say market now starts pricing the 10-year yield, assuming that 5.5% is the low of the interest rates in the current cycle. And then market can put a term structure premium. So at this point, market is telling us that, look, maybe between 50 to 75 basis points spread on the repo rate is the correct pricing of the 10-year yield. And therefore, the 10-year yield in anticipation of rate cuts was already there, right? And therefore, today the market has shown kind of a classic display of buy on rumors, sell on facts. Now that the rate cut is there, people need to devise their next strategy. The liquidity in the market is surplus, the credit growth is slowing down, and there is a huge demand from the banks and the insurance companies and the pension funds for the longer end bond. So once the market is able to digest this huge rate cut, but with the indication of no further rate cuts, the liquidity will then push the institutional investors to invest. So I will expect the 10-year yield to inch towards the 6% level in the next couple of months.
Okay. Hi, Mr. Jaju, this is Kanishka also joining in. I just wanted to ask you, it's been a great policy, but on the global front, especially with respect to tariffs, things do remain slightly uncertain. So what's your outlook there? How should we be navigating that?
Yeah. So insofar as the global uncertainty is concerned, in relation to the monetary policy, I think the governor spelled it out that as long as there is uncertainty on the external front, it is important to ensure that the domestic financial markets remain stable, they operate smoothly, and there is no disruption. And towards that end, they have injected liquidity more than what the market needs now. They have upfronted the rate cuts. So therefore, the global uncertainty at this point has actually helped the RBI take a more aggressive monetary policy stance. And those uncertainties are not going to go away. That will have its implication in terms of growth and the trade balance, etc. But as far as the fixed income markets are concerned, or as far as the bond markets are concerned, given the fact that inflation is at 3.5% projected by the Reserve Bank at 3.7 actually, and that the growth is projected at 6.5%, but there is still a need for continued push to stimulate the growth, and that the global monetary policy setting is easy. Fed has been cutting rates, and this European Central Bank cut rates yesterday. The long-term rates in US have gone up because of the domestic factors, but India's macro fundamentals are very strong. So I think that is at this point, the global uncertainty is possibly acting as a tailwind for the monetary policy.
Okay.